Over the past 3 months, this tech juggernaut quietly made $100 billion and saw its stock climb 50%. A combination of high growth and low valuation is incredibly rare in the current AI market, and yet despite everything, its valuation still sits under 20 times earnings, far lower than the rest of the Magnificent Seven. So is this a bargain mispriced by the market, or is there a hidden risk no one's talking about? Hello everyone, welcome to Top Trader Cairo. I've been trading stocks for 18 years, and if this is your first time seeing my content, make sure you subscribe. Here, you'll get clean, data-driven market analysis, no hype, no slogans, no emotional chasing. We're going to break down this company through 7 of the most important angles for any investment decision. And if you enjoy deep dive research that focuses on logic instead of trends, give this video a like and hit subscribe. Over the last 2 years, Google has been the most undervalued member of the Mag 7. Its AI strategy isn't slow, and its business fundamentals aren't weak. Yet its P/STI stuck around 18 to 19 for a long stretch. It simply couldn't lift. But now, after a strong earnings beat and a run toward new highs, it's time to figure out whether this valuation recovery signals a genuine turnaround, or whether there are still landmines hiding underneath. After Google released its Q2 2025 earnings, the stock bounced immediately and is now pushing toward all-time highs. Why is the valuation finally repairing itself? The short answer, in the near term, Google held its ground. Look at the Q2 numbers. The company outperformed expectations across multiple core businesses. Search revenue grew 11.7% year-over-year, far from the ChatGPT will destroy Google narrative. YouTube grew 13% thanks to Shorts and connected television expansion. Google Cloud jumped 31.5% and is now contributing profits. And stripping out a one-time $1.4 billion legal charge, margins were basically flat to slightly above expectations. Google also raised its full-year CapEx guidance, making it clear that AI investment will continue aggressively. All of these signals tell the same story. AI hasn't actually hurt Google's business in the short term. That's why the market started to unwind its overly pessimistic outlook, lifting the stock from 140 toward 190, approaching the highs seen in late 2024. But if everything looks so strong, why is Google still this cheap? Among the Mag 7, Google is the last one on the valuation ladder despite stable growth, steady cash flow, and a clean balance sheet. The reason is a long-term structural risk that hasn't gone away. Google's core business search advertising might eventually be disrupted by AI itself. Search still makes up more than half of Google's total revenue and contributes nearly all of its profits. And large language models pose their biggest threat directly to this business. That puts the market in a strange position, confident about Google's short-term resilience, but unwilling to bet heavily on its long-term structure. Right now, Google looks something like this. In the short run, revenue is solid. User behavior hasn't dramatically shifted, and AI-powered ad tools are actually increasing monetization. But in the long run, if OpenAI fully commercializes search ads and begins systematically redirecting traffic, Google's dominance could weaken and its business model could face real pressure. A P/STI of 20 reflects that exact balance, fair pricing on current performance, but with a discount baked in for future structural uncertainty. Look at Meta as a precedent. Meta crashed to a 12 times PC in 2022, then surged back above 25 after Reels beat TikTok's momentum and its AI ad system took off. Many investors hope Google can replicate that same turnaround. So now everything comes down to one question: is Google's search foundation actually stable? Will AI meaningfully erode Google's market share? In the next section, we'll break down 3 core datasets to see whether the threat is real or whether Google keeps proving the market wrong every earnings cycle. To evaluate the stability of Google's search business, we need to look at 3 angles: whether revenue growth is still healthy, whether user behavior is shifting, and whether AI is changing the structure of search. First, revenue. Q2 search revenue grew 11.7% year-over-year, slightly above last quarter's pace. What does that imply? For now, AI hasn't damaged monetization. Advertisers are still spending aggressively, and as Gemini and PMax continue to integrate, many advertisers report that AI tools are improving ROAS significantly. Even when Temu and Shine paused ad spending in April due to tariff issues, Google quickly filled the inventory. There were no empty ad slots, no soft spots. Search isn't just defending, it's adapting and pushing forward. Second, market share. Yes, data from SimilarWeb and StatCounter show Google's search share slipping from roughly 92% to around 89%. but that is still a crushing level of dominance. Meanwhile, the AI tools many believed would steal search, ChatGPT, Perplexity, have strong user engagement, but are still far from becoming a meaningful commercial entry point for advertisers. Safari declines and shifts in user preference are real trends, but they haven't translated into major losses in ad budgets. Google's role as the default gateway of the internet remains intact. For now, third, AI overview. This is the most important structural shift to watch. AI overview keeps users inside Google's page longer, which helps engagement but reduces outbound clicks. That's a direct hit to the partner-side ecosystem. It's no surprise that Google's network ad revenue fell another 1.2% year-over-year, the fourth straight quarter of decline. This drop in network ads is the cost of AI transformation, and it shows how Google's strategy is shifting toward a more closed, self-contained ecosystem. But it also raises a much deeper question. If AI summarizes everything on the page and answers directly, how do you run ads in that world? Where does the click go? And how do partner sites survive if nobody leaves Google's interface? Google hasn't offered a unified answer yet, but what's clear is that it's rewriting the rules of the entire search system. The core business is stable, and more importantly, Google isn't sitting still. It is actively reshaping itself. The valuation rebound is happening because the numbers are solid, and the fear is fading. But one question still hangs over the market. Can Google use Gemini to build something more powerful than traditional search ads? That's what we'll explore next. Earlier, we talked about how Google's search business is still holding up, but the underlying structure is already changing. And at the center of all of these changes is Gemini. It's Google's primary weapon in the AI race, and the key to whether the company can extend its advertising empire into the next era. In terms of capabilities, Google has plenty to work with. It owns the most complete AI stack in the industry, its own TPU chips, its own cloud computing platform, its own large language model, and a massive global distribution network that includes Search, Gmail, YouTube, Chrome, and Android. Few companies on Earth can compete with a vertically integrated system like that. OpenAI and Anthropic might have cutting-edge models, but they don't have Google's platform reach or its global user base. And when it comes to data, Google operates at a level no other AI company can touch. Every search, every click, every location ping becomes training fuel for Gemini. This integrated loop search, ads, user behavior, cloud infra is a moat most AI startups can only dream of. By all logic, Google should be steamrolling the competition. So why doesn't it look like that? Why has Gemini's rollout felt slow? Why did some launches fall flat? Why does Google feel a step behind in model rankings? The issue isn't capability, it's structure. Google knows it needs to go all in on AI, but it's handcuffed by its existing business model. The stronger Gemini becomes, the less users click across the web, and the weaker Google's core search ads become. It's a direct conflict. The more successful the new model is, the more it harms the old one. This is the classic innovator's dilemma. You have to destroy your own winning product before someone else does it for you. But no one wants to willingly shrink a business that generates billions of dollars every quarter. Management understands the logic, but stepping on the gas is far harder than acknowledging the problem. That's why OpenAI can push out Sora, GPT-5 experimental agents, and rapid commercial tests. While Google's big announcements often feel awkward or late, OpenAI can afford to bet everything on the new world. Google has to defend the old one while trying to build the new one at the same time. So today, Google's biggest challenge isn't AI talent or technological strength, it's courage. You can't transform and also try to keep every part of the old system untouched. That hesitation is what risks costing Google its most valuable asset, the window of opportunity. Google's valuation has hovered around a 20 times PSIE, and this isn't the market being blind, it's the market being cautious. That multiple reflects one thing: uncertainty. Specifically, uncertainty around whether Google can successfully reinvent its business model in the AI era. Investors are essentially pricing three possible futures. First, the optimistic case, roughly a 30% chance. Gemini breaks through, integrates tightly with search, and establishes a new AI-first information gateway. In that world, Google rewrites the structure of search itself. A fair valuation could move to 25 to 30 times earnings. Annual returns might fall in the 12 to 18% range. Second, the base case, about 50% probability. Google's core search slowly declines, but doesn't collapse, while YouTube and cloud grow steadily enough to offset the losses. In this scenario, Google behaves more like a tech utility, hovering around 15 to 20 times earnings with mid-single-digit to low double-digit annual returns. Third, a pessimistic path, roughly 20%. If large language models rapidly cannibalize traditional search, Google's ad profits could shrink dramatically over the next 5 years. Valuation might compress toward 10 to 15 times earnings, and annual returns could turn negative. Blend these scenarios together, around 19 times earnings, and the market's current pricing near 20 times looks almost perfectly aligned with that probability-weighted outcome. This explains why Google's stock sits near all-time highs, while the valuation remains muted. From an investor's perspective, Google today sends a very clear structural signal. It's no longer purely a growth stock, but it might be one of the more interesting mispriced value opportunities in large-cap tech. At around 20 times earnings, the market's logic is straightforward. Search hasn't collapsed, YouTube and cloud are still growing. AI investment is heavy, but manageable. The only real uncertainty is whether Google can adapt its business model over the next 3 to 5 years. If you believe Google can integrate AI into its existing ad ecosystem, just like it successfully transitioned into mobile a decade ago, then this level offers a solid margin of safety for a long-term position. And if you're more focused on shorter-term trades, the combination of positive sentiment, stable earnings, and depressed valuation creates a classic expectation reset window, especially heading into the next earnings cycle or major AI product event. But all of this depends on one thing: accepting that Google is a slow mover. It won't explode upward, but it also doesn't blow up easily. It rewards investors who are willing to wait for a long-term strategy to mature. If you've listened this far, you already understand Google better than most. Did Google's earnings match your expectations? Would you buy the stock here? Share your thoughts. I read every comment. And if you enjoy content rooted in data, logic, and clear reasoning, make sure you subscribe. I'm Cairo, and I'll see you in the next video.